Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. As always, there's so much going on in the world of investing. A lot to talk about. How are you going?
I'm well. Keen for this. We're going to cover off a look into the politicians of Australia and the US and try and understand a bit more about what they're investing in.
Yeah, that has certainly been news of the day.
Yes.
With Peter Dutton. We'll get into that.
We've got a community question around ethical investing. So we're going to, I guess, check in on it because it's gone missing for the last few years. But to start, as always, we've got news and views.
News and markets.
All right, Bryce, well, let's kick it off. And I think as so many investing conversations have started and finished in the last, 18 months, NVIDIA is in the headlines. It reported its quarterly earnings. The company that the world watches to see if everything's going to be okay.
Yeah.
So let's talk about that. But I think the context that's quite important that people may not have really clocked is it's been a bad start to the year for big tech.
So much so that the Magnificent Seven are in a correction.
Yeah. Now, a correction is a 10% or more drawdown.
Yeah.
And then you get into a, what is it when it's 20% or more? Crash.
Yeah.
Is that what the technical term?
Yeah.
Yeah, okay.
Yeah. Bear market.
Yeah.
Yes. Crash. Bear market.
So we're in, big tech is in a correction. Bloomberg have a Magnificent Seven index that just track the big seven stocks. Tesla, Amazon, Apple, Microsoft, Alphabet, Meta, NVIDIA. Yeah. So Tesla has been the worst performer of the seven. It's down 39% since the index peaked in mid-December.
Since Elon became head of Doge.
Well, yeah.
Took his eye off the ball.
Correlation or causation. Notably, Tesla now back below $1 trillion market cap. But that isn't the only of the big seven that have fallen.
No. Amazon, Microsoft, and Alphabet are all down at least 10%. With Meta, the only one that is up. They're up. It's up 5%. And we all know where the Magnificent Seven goes, the market follows, and that is evident with the S&P 500 also down 2% since the peak in, 17th of December.
Yeah. Now, it's important to keep in mind that we're long-term investors here, and if the more you zoom out, the better the story looks, and that is repeated story in the share market. There's always short-term noise. There's always Bitcoin crashing or the Magnificent Seven falling or Chinese warships off Australia's coast or allegations of insider trading by prominent Australian politicians. There's always noise.
There is.
But the story of the stock market is a story of innovation, of new businesses coming to market, and of those next companies taking the baton and driving the index forward. And Bryce, I think that is a perfect segue to the company that has taken the baton and driven the index forward. NVIDIA reported their earnings.
They have reported their earnings, beating expectations. They had a record quarter in terms of revenue, delivering just shy of $40 billion in revenue, operating income of $25.5 billion.
For people that have been following the NVIDIA story, the particular subsection of its earnings that you pay close attention to is data center earnings. That's where this AI infrastructure build out and story is really taking place. Data center revenue, $35.6 billion. So, you said quarterly revenue was $39 billion, and this is 35 of that, up 93% year on year, up 16% from a quarter ago.
Yeah, huge growth.
So almost doubling its key revenue driver in a year. Like that is just incredible. The important thing for markets is that it revenue came in at the top end of the range, and then profit beat expectations.
Yeah.
So as we know, reporting season or earnings season is an expectations game. You can report a great set of numbers, but if the market expected more, your share price can fall, and vice versa. You can report a shocking set of numbers, but if it's better than what the market expected, your share price can rise. Nvidia continues to just beat expectations, which is impressive because expectations for this stock are just sky high.
So, Ren, speaking of data centers, we need to give a mention to Supermicro, the company that we've been speaking about on the show a bit of late. Mr. Beat-Up has brought it to our attention. They have also reported earnings, and the stock has gone incredibly well. They have increased revenue. Well, they've doubled revenue to almost $14 billion same time last year. But the good news is that they have avoided a delisting on the NASDAQ, which is what all the investors were waiting for. So good news for Supermicro.
Yeah, it is good news. All right, well, Bryce, as we wrap up the news of big tech, I want to ask you a question without notice.
Yep.
So if we zoom back out to the Magnificent Seven, none of them have done particularly well in the last couple of months. Mm-hmm. Which one are you buying?
Which one am I buying? I'm still going Alphabet. Yeah. Meta's not bad.
So I've had a look at them all, and just looking at price to earnings based on their most recent earnings, so not factoring in any growth. Alphabet's price to earnings 22. Meta, even though it's been the best of the 7 in the past couple of months, 27 price to earnings, which means that both Alphabet and Meta are cheaper on a price to earnings basis than Commonwealth Bank.
Nice.
But if we continue...
Definitely not buying CBA.
Microsoft 32, Apple 38, Amazon 38, Nvidia 51 puts all of them cheaper than REA Group.
Wow.
Yeah.
Wow.
Aussie growth stocks.
High quality companies here. Yeah.
But some of these companies are pretty compelling.
Definitely.
I mean, Alphabet for me is just...
Yeah.
Yeah,
love it. Well, if you want to keep up with all of the news beyond just the reporting seasons, make sure you're subscribed to our daily newsletter, where we'll send you a summary of the most important business and market headlines from around the world every morning straight to your inbox. And the good news is, if you would like to listen to them, we have a podcast that delivers them in audio form. It's called Headlines by Equity Mates, and you can find it in your podcast player now. The focus may be on Peter Dutton, but he's not alone. We're taking a look at some of the Aussie politicians and what stocks they're trading.
So, Bryce, the story of the day is Peter Dutton and his purchase of stock in some of Australia's big banks during the GFC, which was disclosed on his parliamentary register one day before the Kevin Rudd bank bailout was announced.
Yeah.
Now, for some... it's just unfortunate timing. For others, there's an insinuation that it's nefarious and that potentially he was briefed on the upcoming bailout and acted on that. We obviously have no idea the truth of that, but it's definitely a story, and it's a story that probably hasn't been spoken about as much as we would have thought. It seems that his property portfolio, which was reported on a couple of days later, got more play than this.
Yeah, not surprising. So apparently he's traded up to $30 million in property over his time.
Yeah.
Which is, I mean, yeah, he's done well. I'm actually just reading here. So he's just done an interview with 2GB's Ben Fordham. Ben asked him for some stock tips. He said, I don't have any, but I've been an investor since I was 19. The compounding on that, pretty impressive.
It's interesting. I think there's an argument that this is going to backfire on Labor, that Australians are quite aspirational. It's like we have a dichotomy in us. On one hand, we have this tall poppy syndrome where we hate people getting over their skis or too big or too rich or too powerful. And on the other hand, there is I think there would be quite an admiration for the story that he's going to spin. You know, he's been saying that he was a butcher's boy and he was working hard.
Double
and never
shift
stopped.
as a police officer. We worked our way up, built small building company. Dad was a builder, bought blocks of land.
Yeah. So it will be, the politics will be interesting. I think we shouldn't lose sight of the forest for the trees, which is if it does come out that he got inside information and he traded on it, that is
criminal
a crime
activity
that you or I would go to jail for.
Yes.
Or be heavily fined for at least. But look, politicians and their stock purchases, it is certainly front of mind for a lot of people because it's not just in Australia where it's a story. Over in the US, Nancy Pelosi is known as one of the best traders of her generation. She's delivered more than 700% return between 2014 and 2024. She has some incredibly well-timed sales and buys. That 700% works out to be about 22% a year. So she hasn't actually beaten the NASDAQ by that much, but...
Oh, you wouldn't complain with 22% a year. That's slightly better than Buffett's long-term average, but obviously over a much shorter return. But who can go past Donald Trump?
Yeah,
very active investor.
Trump Media and Technology Group, and I guess Trump Coin now as well. So politicians and their stocks. Without getting on a soapbox too much, I don't understand why we don't mandate.
Ban it.
No, just mandate blind trusts.
Oh yeah.
Like if you are gonna lead our country, you just put your money in a blind trust. And I think the obligation of being an elected representative is your spouse's money probably has to be put in a blind trust as well.
Yeah.
I don't think that's too much to ask.
Yes.
But anyway, separate conversation. So we had a look at Aussie politicians and their investments because it is all public, not quite as public as we would like in terms of disclosing dollar amounts and shareholdings and stuff like that. But you get a general idea. So let's start with the eternal debate, stocks versus property.
Well, it's very clear where politicians land on this debate, Ren. Since the 2022 election, 83 members of parliament have declared shareholdings, so stocks. On the other side, when it comes to property, 12 have declared that they don't have a home. 67 have declared that they have one home, meaning 148 of them own multiple homes.
Yes. So now the question is who owns the most homes? It looks like there's a tie. Karen Andrews from the Labor Party and Michelle Ananda Raja each own 7 homes. Now, you think that's a lot, but we dug through the archives. Barry O'Sullivan, who was a national senator, no longer a national senator, like no longer in parliament, he owned 33 homes or 33 properties.
Wow.
Yeah.
Wow.
That's the Australian dream.
That's the dream, yeah. Oh, goodness.
Yeah, I think David Gillespie tops the Nationals now. Between him and his spouse, I think is also 7 homes.
Right.
Yeah.
So do we have any insight into what they're investing in from a stock point of view, if at all?
Yeah, I was going to not put these in our prep doc and play a game with you, but I think everyone just take a second and think about what stocks are most commonly held.
Top 200.
Before,
Blue chips.
But in particular, well, let's go bottom to top. So coming in at 5th place, equal 5th, held by 11 politicians, and this is individually held, like not in an ASX 200 ETF, Wesfarmers and ANZ.
Yep.
Coming in at 4th place, 12 politicians, Westpac. 3rd place, 13 politicians, BHP. 2nd place is a tie, CBA and NAB with 15 politicians. So we've covered the big 4 banks, we've covered Wesfarmers and one of the big miners. Yeah. No surprise. Maybe this actually was a bit surprising for me. 25 politicians own this company. It's slow growing. It's boring. Some may argue it's going backwards. It's Telstra.
It's unbelievable. It's seriously underperformed the market over the last 5 years. Yeah. It's like these pollies need a lesson in investing.
Owned by 25 politicians.
There you go.
Now, we can get the individual shareholdings for different politicians, and we thought, okay, well, Peter Dutton's in the news. Maybe let's have a look at what Anthony Albanese owns in terms of shares. Drum roll, please. What does he own?
Nothing.
No shares.
No shares.
4 houses.
Yeah. 4 properties. No house, no shares.
Disappointing.
Very disappointing. Come on, guys. How are we supposed to encourage people to build wealth outside of property?
Yeah, when you're all just speculating on houses.
Yes, anyway.
And then finally, members of parliament that own the most shares. Now, this isn't dollar amounts because they don't have to report that. They just have to report the stocks that they own. So from the Liberal Party, Paul Scar, 25 individual shareholdings. And then from the Labor Party, Jed Carney, 38 individual shareholdings.
Well, I think the main thing here is clear that Pollies need to get a little bit more invested in the stock market, but they are certainly living the Australian dream.
Buying property, speculating on property.
Speculating on property.
If you've ever wondered why there's such a political incentive to keep the property market going and why every housing affordability measure doesn't actually bring median incomes and median prices back closer together. Instead, all it does is just pump more money into people's pockets. This is the reason why.
Well, look, we're going to take a quick break, and on the other side, we are going to take a community question around ESG investing and understand if we still have to make a choice between our values and investment returns. We'll be right back. ESG investing was the biggest trend in 2021, but for the past 4 years, we've heard crickets. Today, we're checking in on ethical and sustainable investing to see if you need to choose between your values and investment returns. And it comes from a community question, Ren.
Yeah, that's right. This question came in from Estelle, and she wrote, I'm passionate about the environment and sustainability, and I'm aware that investing in an ETF may mean investing in companies which are not sustainable at all. I am caught between my principles and values and the opportunity to be able to invest, and was wondering if you had any advice on how to approach this for someone like me. I know a bit of ESG funds, but here they are not necessarily good investment options. Any other options for people like me, or are we doomed to choose between our values and investing?
Great question. Yeah. Thank you, Estelle. A reminder, if you want to ask us a question, there'll be a link in the show notes or the description below. You can leave us a voicemail or fill in the contact form. So, Ren, we should probably just start with a quick refresher on what ESG investing is. It's really where a fund considers sustainability, so things like environmental, social, and governance factors to inform their investing strategy. Yeah,
and generally we see two types of ESG funds, a negative screen and a positive screen. So a negative screen is where you eliminate bad companies, quote unquote bad companies. So you say, we're going to take the ASX 200 and eliminate all mining companies or all oil and gas companies, and then all of a sudden it's the ASX 200, but it doesn't have Woodside and Santos and a few others.
Gambling, whatever.
Yeah, true. Gambling, another one, On the flip side, you can have a positive screen, and that is really focused on improving companies. And that can be split in two ways. It can be focused on companies that are improving. So you define a set of criteria or metrics, and you say companies that might be quote unquote bad, but are improving, we can invest in them. And also it can be focused on improving companies in terms of actively engaging with companies to try and improve them. And so it's like, we're going to buy a coal miner and, engage with its board to do whatever. I'm not sure how much you can do with a coal miner. That's probably a bad example. We're going to buy a supermarket that's heavily polluting, and we're going to try and drive a green energy focus for their energy procurement, or whatever it is. We're going to buy AGL and try and drive clean energy generation.
Turn off all their power stations.
So they're the two types, positive and negative screens. There's no right or wrong option. It's just what you personally want to invest in.
Now, there are a number of ways that you can actually invest in this ESG or ethical thematic. And a lot of them really did start coming to the fore in around 2021, when it felt like there was just a huge influx to the market, particularly with ETFs and managed funds and super funds. So that's probably, I guess, the biggest chunk is ETFs, managed funds. There's a lot that have like a socially responsible option or an ethical tilt.
Yeah, your super, you could also go with a super fund that is like Future Super, for example. And similarly, there are ETFs that are issued by the main guys that have an ethical tilt, like beta shares have a bunch. But then there are also fund managers that purely try and invest ethically, like Australian Ethical Investments. So that's really the bulk of the investment options. But these days there's everything. You can get sustainable bond funds and, every asset class. If there's a way to invest in it ethically or sustainably, there will be a fund manager that responds to that market incentive.
Sustainable Bitcoin.
Now that is something I haven't seen, but that is interesting.
It wasn't that Iris Energy? Wasn't that their whole thing?
True.
Using
Well, yeah.
solar to mine Bitcoin.
Yeah. That's
technically.
True.
Yeah.
Anyway, so for this analysis, let's focus on two of the more popular ETFs in Australia. It's the BetaShares ones, EFI, which is their global sustainability leaders, and FAIR, which is Australian sustainability leaders. So let's start with EFI. And because really, Estelle's question got to, am I forsaking returns for
that's the
my
crux.
investment choice? So EFI, and I've compared it to Vanguard's VGS, a global index investing fund. EFI over the last 5 years has delivered 16.1% return. VGS over the past 5 years has returned 13.9%. Both of those are per annum.
I guess that would be surprising to some people to see ESG outperforming there.
Yeah.
Good to see.
I think probably not as surprising when you look under the hood of the ETFs.
Yes.
Because the reason that the global ETF, the ethical version, has outperformed the unethical version is the tech exposure.
As in there's more of it?
Yeah. The global trade of the past 5 years has been get as much tech in your portfolio as possible.
Yes. Well, I'm just looking at the top holdings. So you've got Apple, Nvidia, Visa, MasterCard, Home Depot, Toyota, ASML. So some big hitters in there.
And yeah, just to reinforce the point, so EFI, 31% of the ETF is in information technology or tech, and for VGS, it's 26%. That has driven some of the outperformance. So that is on one hand, Estelle, you're not having to trade off returns for an ethical product. In fact, your returns have actually been better. The story does flip when you come home to Australia. So FAIR, the Australian Sustainability Leaders ETF, that's delivered 5.5% per annum for the past 5 years, whereas the A200 ETF, just tracking the top 200 ASX stocks, has delivered 8.1% per year. So that's 2.6% less per year.
Yeah, and I guess the big driver for that, looking at the top holdings of FAIR, the biggest emissions are obviously all the miners and the big banks. So given that they make up a huge proportion of the ASX 200 and drive a lot of those returns, that makes complete sense.
Yeah. So I think, look, to put a bow on it, the sustainable ranges and the non-sustainable ranges, or just the standard ranges, they will perform differently at different times because they have different underlying holdings. But over the long term, they will all deliver enough of a return to get you to where you need to go, or get you closer to where you want to be than not investing at all.
You can still invest based on your values and not be so disadvantaged that it's not worth it.
Yeah, and there is an argument that over the long term, ethical funds should outperform because they screen out companies that are in industries that are going to die off, and they then naturally are more overweight than the index companies that are where the world is going and investing for the future. And so, that, let's see if that plays out. But if you're worried that ethical products aren't worth it to start investing, I think that's completely wrong. I think they are definitely worth it to start investing, and you can definitely build a portfolio around ethical products. Think about your super as well, because it is going to be like this massive chunk of money that if you care about how, your super fund engages with boards and stuff like that is, you can really be part of a bigger collective allocating your super that way. And the final thing I would say, and they may not love me saying it because I don't think they position themselves as an ethical or an ESG fund, but the best performing listed ETF in Australia last year, and one of the best performing actively managed funds in Australia, listed or unlisted last year, was a climate fund. It was Munro's Climate Leaders Fund. And I think, again, they don't call themselves ESG, but if you're going to put out a Climate Leaders Fund and invest in renewable energy and the energy transition and the associated companies that are part of that value chain, then I think you fall in that bucket.
Well,
and they delivered, I think, 67% in 2024. Yeah,
it's literally a portfolio of global companies driving and benefiting from the structural shift towards a low carbon economy.
Yes. So that was the best performing listed ETF in 2024.
Yeah.
So the idea that like you're forsaking returns for ESG is just not the case at all.
Yeah.
It just might be that you need to look a little bit more active in some markets, or find the right manager, or just know that, your returns won't be always tracking the index, but over the long term, they'll still compound all the same.
Yeah, this fund focuses on clean energy, sustainable transport, energy efficiency, and the circular economy.
Yeah, but didn't we call them an ESG fund at one stage?
They didn't. They're not an ESG fund.
Yeah. Which I reckon points to how much the brand of ESG has fallen off. Yeah.
But we'll leave that debate there. Thank you so much for the question. As we said, Estelle, if you'd like to ask us a question, there'll be a link in the show notes for you to leave us a voicemail, or head to equitymates.com/contact and you can fill it in the form that you'll find there. But that brings us to the end of today's episode. If you love what we do and take a lot of value from it, then if you could leave us a rating and a review on your podcast app, that would be much appreciated. Stick with us, because next episode we have Ben from Seneca Financial Solutions doing a buy or sell with Adam from Comedian v Economist. But Ren, for us, we'll leave it there and pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.